Welcome to the Three Edge Week in Review for the week of April 7th. I'm Fritz, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will discuss the Trump administration's ongoing tariff policies and what seems to be stacking up as a potential trade war between the U.S. and China. As we know, on Wednesday of this past week, President Trump hit the pause button on additional tariffs on a wide range of countries, which sent the global market soaring. However, with a 90-day pause on reciprocal tariffs, there's still 10% tariffs on most goods imported into the U.S. Those remain in place. And additionally, perhaps more importantly, at the same time the president announced a pause, he also singled out China for even higher tariffs. And U.S. tariffs on goods imported from China are now somewhere well over 100% and have seemed to ignite the potential for a trade war. Meanwhile, in the coming weeks, the U.S. will be negotiating with its other major trading partners to attempt to reach negotiated settlements. So I'm going to bring Steve in here right away. So Steve, seems like the tariffs will be in the news for the foreseeable future. So let's begin by simply explaining what tariffs are and how they work, sort of tariff 101, if you will.
So tariffs are actually very simple. When we impose a tariff on another country, what we're actually doing is we're assessing a tax against a U.S. company that imports a good from another country. So it's a tax on a U.S. company who's an importer. And then that importer, in addition to paying for the foreign good to import it, they now have to pay a tax on that good to the U.S. government. And in the case of China, like you said, it's over 100%. Let's say Target imported a $10 product from China. They'd have to pay the $10 for the product to China. They'd have to pay something above $10 tax to the U.S. government. And then they have to decide, do they raise the price of that product to the consumer, or do they eat into their own profits?
Okay, so with all the talk around the tariffs these days, we're hearing a lot mention of the Smoot Hawley tariffs of the 1930s. And so perhaps it would be helpful if you could give a brief description of the, I guess they were infamous Smoot Hawley tariffs enacted prior to the Great Depression.
Well, I have to say that there are some amazing parallels between what's been happening in the U.S. in the last few months and what happened back in the late 1920s and early 1930s. In 1928, there was an election in the U.S. We elected a president, Calvin Coolidge, who had a business background. And people were very excited about that because the stock market was making new highs. It was the roaring 20s. And that was thought to be able to keep this rally going. However, at the same time, there was a growing sentiment that from politicians, from workers, from other government officials, there was a growing sentiment that the U.S. needed to prioritize its own economy over the international cooperation that had been set up over the last several years before that. And people in the U.S. started to feel threatened by trade deficits. And so many politicians got together and believed that tariffs would be the silver bullet, that they would stimulate the economy by encouraging U.S. production and reducing imports. And so Congress enacted the Smoot Hawley Tariff Act of 1930. Calvin Coolidge, the president, enthusiastically signed it. And it spectacularly backfired because it led to retaliation by other countries. Then, with all the interconnectedness in the global markets, there was a sharp reduction in global trade. And not only did we go into recession, but we went into a global Great Depression. And there's a great quote from a German philosopher that I remembered from some time ago that applies. And it says, "The only thing we learn from history is that we don't learn from history, or we learn nothing from history."
Very good. All right, great. So now let's get into a bit more detail and discuss goods trade deficits and their relationship to tariff, because I believe there's a lot of confusion in this area. So perhaps you could help us out here.
Sure. And as far as the trade deficit goes, there's a goods trades deficit and there's a services trade. And we actually have a surplus when it comes to services, and 70% of our economy is services. So that's good news, but we don't hear a lot about that. But in terms of goods, we have a deficit. And what that really means, simply, is that we buy, as U.S. consumers, we buy more goods than we can produce. And so we buy them from foreigners in addition to buying them from ourselves because we can't produce the amount of goods that our consumers want to buy. Now, given full employment, if we really wanted to produce as many goods as what we're buying, we'd either have to increase the labor supply dramatically by inviting a big influx of immigrants to help make more goods. And politically, we seem to be doing the opposite, so that's not going to happen. Or we need to engineer a recession so that we buy fewer goods. And I actually heard a couple of cabinet members in the administration saying maybe that's not a bad thing. We don't need all the goods we buy. So those really are the two options. Now, the other thing is that there's something called the balance of payments. It's an accounting identity. It's like Econ 101, that you always have to have a balance between the trade deficit and the capital account. The trade deficit has to equal the capital account surplus. So if a country buys more from foreigners than they make, and they do that, then they need more capital from foreigners to come into that country to help pay for that. And so we have a trade deficit and we have a capital account surplus. If we got rid of the trade deficit, if we eliminated the trade deficit, that means we have to eliminate the capital surplus. However, that's not such a great thing, because what it means would be the capital surplus are foreigners buying our stocks, buying our bonds, helping us fund our debt. And so if there's a threat to the trade deficit, or if there's a threat to trade, and foreigners start buying fewer stocks, they start buying fewer bonds, and they're not there to help pay our debt, and we need to roll over lots of debt in the near future, that's a big problem. So I think a lot of people have been focused on one side of that equation without realizing that this is an accounting identity. There are implications on the other. And just this week, we saw what happened when the bond market started to collapse. Now, some of that was hedge funds being overly leveraged and getting out of those leveraged trades. But because we know the dollar's been falling this week, we know that some of that are foreigners retaliating by not buying as many stocks and bonds as they used to. And that could be a big problem.
All right. So now we're going to go peel that onion back, a little further. And let's consider some of the possible scenarios, right, going forward from here, regarding the tariffs. What are the goals of imposing these tariffs, and how might this play out? There are a couple different avenues.
So the most optimistic thought is that the tariffs are simply a negotiating strategy, and that they'll all get removed when either there are concessions, or there's a mutual de-escalation, or the tariffs get delayed indefinitely. So that's best case scenario. And we saw the impact in one day when there's a tariff delay. The markets just love that. It only lasted one day, but it shows you how there's a hope that these tariffs are going to go away, and that it's just simply a negotiating strategy. Now, the 1930s lesson was that was the hope back then as well. Right. But it didn't work out that way, because you do something that's in conflict and you might get retaliation. And then instead of a zero-sum game where you lose and I win, it's a game theory where everyone loses because everyone's in the same interconnected market. So what you end up with is the tariff turns into a trade war. Then that can turn into a currency war, because another way that another country can fight is well, if you're raising the tariff and you're making my products more expensive, then I'll just weaken my currency to make it less expensive again. And we know that leads often to a global recession if everyone's trying to weaken their currency. And then finally, worst case scenario is we get stagflation, which is a recession and rising prices at the same time because the tariffs are still there.
All right. So as always, my final question is, with such an outsized degree of uncertainty around all of these tariff policies and the potential for trade wars, How should investors think about positioning their portfolios in this environment?
Well, with the threat of these tariffs existing for some weeks, we believe that it was important to be cautious with one's equity allocations and not go too far out on a limb, because there's a risk of recession, because there's a risk of stagflation. And frankly, we began to be more defensive and pull back our equity allocation all the way back in February. We did it again in early March. We did it again in mid-March. We did it again in early April. And we'll see if there's yet even another step to take. But that's one recommendation. Now, given the degree of overvaluation, and markets and investors don't care so much about valuation when the market's going up, it's just all about trend following and the fear of missing out. When the market starts going down, everyone starts to ask, well, how far could this correction go? Where is fair value? And based on our calculations, fair value is still substantially below where we are today. This correction could have more further to go. Now, the question is, if you're reducing equities, what do you hedge? Well, we've seen recently that traditionally long-term bonds are a hedge for equities, and they've been working terribly since 2020, and they've been working terribly even more recently. So we think the best hedges are gold, treasury bills, and TIPS. Gold is an excellent hedge against potential weakness of the dollar, and we saw that if trade starts to collapse, if countries don't want to do more business with them and they pull back and not buy our stocks and bonds, that's weakening the dollar. And gold is an excellent hedge against a weakening of the dollar because gold is simply traded in terms of dollars. U.S. Treasuries are a good hedge because it's a good, safe way to store capital. And if the market does continue to correct, it's dry powder to be able to buy into the market when it's at a much more favorable valuation. TIPS are better hedged than bonds, in our opinion, because not only do they protect against recession, but they also protect against inflation because as the inflation rate rises, the TIPS produce more income.
Excellent. All right, good. Thank you. We covered a lot of ground here today on tariffs, trade wars. I hope that we provided some clarity to our listeners, since tariffs and talk of trade wars will likely be with us for the foreseeable future. And I think this heightened level of uncertainty reinforces our approach, which you just reviewed, of building resilient portfolios. So that will do it for Steve and for me this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone you think might benefit from our weekly videos, please feel free to share them. And if you enjoy the videos, please consider subscribing to our 3Edge YouTube channel. We would be most appreciative. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.